I think what Chris Waller was saying is that he's open to doing more in later meetings if the data come in that way, because there's not a lot of data between now and September 18th that would convince you one way or another. So I think the Fed's default is 25 basis points. The numbers came out today without giving you any reason to really move away from that. And so because we're not getting any strong signals of 50 at this point, I think that 25 is probably the best guess.
Sophia, let's bring you in here. What's your reaction to the jobs report, and do you still think that the Fed will only cut 25 basis points?
Yeah, thanks so much for having me. I got to totally agree. We are still in the 25 basis point camp. That's sort of what the Fed has been teeing up. And I think exactly what you heard from Waller this morning suggested that should subsequent data, that's the term that he used, he said if subsequent data shows increased weakness in the labor market, he'd be prepared to make a bigger cut. But to us, that suggests that means future employment reports, if you see either further weakening, that might encourage the Fed to go more than 25. So we are looking at 25 basis points in September. That's what we thought before this employment report today. And that's what we still think we'll expect to see in a couple of weeks from the Fed.
Hey, Mike, help us understand the unemployment rate going down. What exactly does that reflect in the month of August?
Well, it's sort of a payback for what we saw in July, where it went up because a number of things reversed themselves. We had a much smaller rise in the labor force. We had more people hired than were let go in the household survey. We also saw things like the number of people who were on temporary layoff, which had boomed in July and contributed to the rise in the unemployment rate. That fell back. So you'd say this was a decline for all the right reasons, and it's one reason that the Fed doesn't feel a sense of urgency about this, because it's not suggesting that all of a sudden people are losing a lot of jobs, companies are getting rid of people. This really tracks with what we saw in the Beige Book of companies aren't hiring, but they're not firing people either.
So then, Mike, how do you square the reaction that we're seeing in the bond market with yields falling off, traders pricing in for that 50 basis point cut in September?
Well, they're not really pricing 50 anymore. They've kind of moved it back down to 25, because I think the reality is set in that the Fed is not setting us up for 50. But we are seeing yields fall because basically you've had confirmation not only in the numbers, but in what Waller and John Williams have said, joining the crowd of people who've said we're going to cut rates at the next meeting. So you're seeing that reaction there, and people are anticipating that the Fed is going to be moving the short end lower, and that's caused the yield curve to uninvert. We'll see if it stays that way, but at this point, it's kind of a natural reaction. I don't know why equities are doing what they're doing, but you're the person who covers that. If you can ever explain to me why stocks do what they do.
Well, fortunately, Abigail Doolittle's coming in just a few minutes, and she's going to help explain the equity market reaction. Sophia, I do want to go back to you to get an understanding of what type of data we could see maybe over the next few weeks to change your view that the Fed, well, actually in less than 2 weeks, could cut rates by more than 25 basis points. What would you need to see? What would the Fed need to see to convince them between now and then?
I don't think that there's really that much time and that much data that's going to come out in the next 2 weeks that really could necessarily push the needle. The really big thing would be next Wednesday's CPI report, right? I don't think that you're going to see anything really unexpected there. I think you're going to continue to see progress towards 2% inflation that we've been seeing. And so that I think won't be something that could push the needle. If there was an incredible upward surprise in inflation, maybe. But I don't think so, right? I think between now and the September 18th meeting, we kind of have the majority of the data. And then you also factor in, the Fed's blackout period starts tonight. So we won't hear comments from any Fed officials. And we've heard from the Powell Fed for this whole tightening cycle that they've been very communicative ahead of time. And so I don't think they would want to surprise markets. So we don't have a ton more data. That being said, I think the further meetings, the November, the December, it totally becomes data dependent. And a lot of it's going to be that focus on the employment side, right? The employment report is yet again, like it used to be pre-pandemic, the big market driver. Inflation has sort of fallen to the wayside now that it's doing what it's supposed to do.